Let's imagine for a second that it's October 2025. A financial line has just been crossed in the United States, a moment that feels, completely new, but as we're about to see, it actually fits a pattern that's been repeating for centuries. For the very first time in American history, the cost of just paying the interest on the national debt has officially become bigger than the entire defense budget. We just spent an incredible $895 billion on interest payments alone. That's more than the $874 billion we allocate for our entire national defense. Now, this isn't just some number on a spreadsheet. It's a historic and frankly alarming signal. And here's the kicker. This is not a new story. This exact situation, where the cost of yesterday's promises completely overwhelms your ability to pay for tomorrow, it's played out 4 times before with the world's most powerful empires. And every single time, it was the beginning of the end.
So the real question isn't if there's a pattern. The pattern is pretty clear. The question is, where does the United States fit into it right now? And when you actually look at the data, the picture becomes, well, it's pretty concerning.
Okay, let's just lay out the facts. The U.S. national debt is sitting at $38 trillion. The debt-to-GDP ratio is 125%, which means, the country owes more than it produces in an entire year. And the U.S. dollar has been the world's reserve currency for 81 years. Now pay attention to that last number because it's absolutely critical. The historical lifespan for a reserve currency sits somewhere between 80 and 150 years. That puts America squarely in the middle of that danger zone. So, to understand what the end of a cycle actually looks like, we don't even have to guess. We have a perfect modern template. See, back in July of 1944, at a conference in Bretton Woods, New Hampshire, the world's financial crown was officially passed from the British pound to the US dollar. Let's dig into how that happened. But that moment at Bretton Woods, that wasn't some isolated one-off event. It was the predictable end of a cycle of dominance followed by overextension and finally crushing debt. And it's the same cycle that brought down 4 other global powers over the last half millennium. All right, let's go back and walk through the evidence. We're going to look at the 4 empires that basically wrote the playbook for this pattern, starting all the way back in the Age of Discovery. Each one of them gives us a critical piece of the puzzle. First up, Portugal. After Constantinople fell in 1453 and cut off the old trade routes, Portugal got creative and pioneered new sea routes. This gave them an 80-year monopoly on the incredibly lucrative spice trade. By 1515, they were on top of the world. But here's the fatal flaw. To protect this monopoly, they built a massive global network of forts, and maintaining them cost an estimated 40% of their annual revenue. Eventually, the cost of defending the empire just became greater than the money the empire was making. By 1580, they were broke and got swallowed up by Spain. Next, we have Spain. They created the world's first truly global currency, backed by a literal mountain of silver they found in 1545. But all that wealth led to a fatal sense of security. Just 12 years later, Spain defaulted on its debts for the first time. In fact, it would go on to default 13 more times over the next 90 years. It's the perfect lesson that just having wealth isn't enough. You have to have discipline. Every time they defaulted, the debt was wiped clean, but it always came back larger. Then came the Dutch, and their great innovation wasn't conquest, it was finance. They founded the Bank of Amsterdam in 1609, and it was built on one simple, unbreakable promise. For every guilder you had in the bank, there was real metal backing it up. That trust made the Dutch guilder the world's go-to currency for 150 years. But then, in the 1780s, the bank got into trouble and secretly started printing money to cover its losses. When people found out, the trust just vanished. The guilder lost 40% of its value in only 24 months. It took them 150 years to build that trust, and just 2 years to completely destroy it. And that brings us to the empire we all know, Great Britain. At its peak, the British Empire was massive, controlling almost a quarter of the world. But then came 2 world wars. And in just 6 years, from 1939 to 1945, Britain's debt-to-GDP ratio just exploded, going from an already high 100% to a completely unsustainable 249%. The empire was financially broken. That Bretton Woods conference in 1944, it wasn't some hostile takeover. It was a necessary handover of power to the United States. It took just 6 years of war to break the empire's bank, and it would take them another 62 years to finally pay it all off. Okay, so that's the historical blueprint, right? Portugal's overextension, Spain's repeated defaults, the Dutch breaking trust, Britain's war debt. Now, keeping that pattern in mind, let's turn the camera back onto the United States and see how the symptoms today line up with this late-stage cycle. The first symptom is what you could call a debt spiral. We've got $38 trillion in national debt, and it's growing by about $70,000 every single second. But the real danger here is the feedback loop it creates. See, as interest rates go up, the cost of paying interest on the debt explodes. This forces the government to borrow even more money just to make those interest payments, which in turn can push rates even higher. It's a vicious, self-reinforcing cycle. And what that all boils down to is this crucial point. We have hit an inflection point where the cost of financing yesterday's spending is now officially greater than our investment in tomorrow. Just like we saw at the start, when interest payments grow larger than the entire defense budget, that is the debt spiral, live in action. The second symptom is how the rest of the world is reacting. America's biggest lenders are starting to move their money. For the first time since 1996, central banks around the world now hold more in physical gold than they do in U.S. Treasury bonds. Think about that. They're swapping a promise to pay for a hard physical asset. China has slashed its holdings by 40% to a 15-year low, and for 18 straight months has been stacking gold instead. Even Japan, our biggest foreign creditor, is quietly reducing its exposure. This is a deliberate, coordinated shift away from the dollar. This isn't just random market noise. It represents a coordinated effort to de-risk by the very countries that have been funding U.S. debt for decades. When your most important lenders start trading your government's IOUs for physical gold, it sends a very clear signal. They're hedging their bets. The third symptom is classic imperial overextension, just like we saw with Portugal and Britain. Geopolitically, you have the BRICS nations, who represent 45% of the world's population, openly working on alternatives to the dollar. Militarily, the U.S. is paying to maintain over 750 bases around the globe. And financially, the speed of the debt is accelerating. The U.S. just added the last $1 trillion to its debt in only 71 days. The empire's costs are going up, while the world's need for its currency is starting to go down. And look, this isn't some fringe theory. This is from the U.S. government's own Congressional Budget Office. They project that the debt-to-GDP ratio is going to hit 156% within a decade. Now remember, it took Britain 62 years to fix its finances from a peak of 249%. There is simply no historical example of a major economy hitting debt levels like these and managing to pull off a soft landing. So let's just put it all together on one screen. This is the 500-year pattern. Portugal's reign was about 80 to 130 years. Spain's was around 120, the Netherlands lost it up to 150, and Britain's was 129 years. The United States is now 81 years in, with its interest payments outpacing defense spending, its biggest creditors trading its debt for gold, and its debt growing way faster than its economy. The historical data here is really unambiguous. The pattern strongly suggests that a transition is not just possible, but inevitable. So the most important question we can ask is no longer if the shift is going to happen, but what does the world actually look like after it does? What comes next? This is Voice on Pages. We provide economic intelligence from the world's best books, and we deliver it in 10 minutes. We break down trade wars, debt crises, and wealth strategies so you can understand what's actually happening in the global economy. Be sure to subscribe for our weekly economic intelligence. And if this analysis helps you understand the reserve currency cycle, please consider supporting this channel at buymeacoffee.com/voiceonpages. Your support is what keeps this research independent and ad-free.